Hey everybody, welcome to Trading Capital's exclusive analysis of all the S&P 500 sectors. In today's video, we're going to be discussing a lot of the weekly trends that are occurring and things we need to be aware of. Today we're going to be starting off with XLK, the technology sector. So overall in the technology sector, you can clearly see that it has been a positive last couple weeks, a stellar move to recapture all of the main moving averages. So you're now above the 200 weekly, you're above the 50 and the 20 weekly, and then you're also above the key 100 weekly moving average. This is the big one that I'm going to be paying attention to see whether or not we can get some follow through next week. Now, technology has been the second best performing sector of the year, up 17.29% since basically the start of the year, you can see over here. So when we see that one sector has had a stellar run in a very short period of time, one should naturally expect that there might be some sellers starting to take profits, and I think we are actually starting to see that on the daily chart. This is the weekly chart, so if I flip to the daily chart, you can clearly see that we've had this beautiful run up here, distribution, a little bit of a retrace to that double top, and we haven't officially had an opportunity to break out on the daily chart out of this double top. And this one hammer reversal candle is the daily candle that I'm watching very, very closely to see if we can bust through that on a great degree of volume. But right now that is resistance. Now flipping back to the weekly, obviously a couple of reasons why this particular sector has outperformed most. There's only one other sector that's performed better. When you look at Apple, Apple's had a stellar run. But I believe Apple's into some beautiful resistance. I think Apple has fulfilled its upside target, and I do think we're going to start seeing some trimming around the technology space. And then you look at Microsoft. Microsoft has had a stellar 1 week impulse green bar last week, followed up with a little bit of profit taking and then pretty much closing back in the high range of that bar. But notice how Microsoft, you could not take out that little remainder of the bar despite the S&P and the NASDAQ still trying to hold its bullish trend. And one of the things we have to be mindful about in terms of the technology sector, the XLK sector, is specifically when you look at names like NVDA. NVIDIA has been a powerhouse, and you have to wonder, is there ever going to be profit taking in this particular stock? And eventually, yes, there will be. We're already starting to see some weakness come into the semis, being the fact that the semiconductors, the SMH, finished actually negative last week or on Friday, but the S&P and the Qs finished positive. So clearly there's distribution. This is not a straight shot move up, and if the semis start to show more weakness, then that should weigh on the overall tech space. Now let's look at XLV, which is the healthcare. We'll flip to the weekly chart. Healthcare is a little interesting because healthcare has been beaten up, and we've been watching this key channel for several weeks now, and basically now you've retraced back to this channel. You're still inside of this wide range red bar breakdown, but being the fact that you've had a pretty good momentum push to the upside, healthcare does stand a shot to try to get back inside of this channel. Now, on a week-to-week basis, it's going to be difficult to say whether or not we actually hold by the end of the week inside of this channel, but healthcare is really going to be needing a market bid to move higher. Now, one thing I'm not really happy with about healthcare is that you're below a lot of these key moving averages over here, the blue, the purple 50 week, and then you're also below the 100 weekly moving average. So being the fact that we've bounced off of that 100 here, we came back down, closed below it again, had a magnificent rally, and now we seem to be struggling back below that 100 weekly moving average. My overall downside target for healthcare remains much lower. I still think we have to fulfill the downside move to this wedge pattern, which would likely coincide with a major support hit of this weekly 200 moving average. Now, with healthcare being the second largest sector, we have to keep in mind that it can certainly weigh on the S&P 500 as it's typically seen as a more of a defensive play. And being the fact that technology has rallied so substantially, it's very it's going to be interesting to see if we see any money flow outside of the healthcare sector or outside of technology and back into the healthcare sector. That's one of the reasons why I think we maybe could see healthcare get back into this channel, is purely on a capital rotation basis. I think we will see capital rotate out of the extended energy into more of the depressed healthcare name, especially as the markets, I think, will be moving a little bit more defensively if they realize that the Fed isn't going to be stopping, and then if they realize the overall recessionary impacts that we believe are creeping into the horizon, just in a bunch of other leading data sets that we analyze. Now, healthcare on the year is down year to date 6.29%. It is down 6.29%. So clearly it has been out of favor, which is why I am believing that there might be some capital rotation occurring. And I think we kind of started seeing that. I think it was evident that we started seeing money flowing into key names like United Health, on the daily chart, like getting a nice daily move. J&J as well getting a nice daily move. Merck also getting a nice daily move. And then you look at the semis, and they were actually the ones seeing money flow. So perhaps portion of the extended semiconductors are rotating back into the healthcare. That's kind of what I'm seeing here in terms of the technical price action in the near term. All right, let's touch base on XLY. We'll do the weekly chart setup as well. So in terms of XLY, consumer discretionaries are trading below many of the key moving averages, pretty much all of the major important ones. You're below the 100, the 50, the 200. You can see on the weekly chart, you had a death cross on the weekly chart occur a couple days ago. Notice how, or a couple weeks ago, notice how the death cross occurred and you got a bounce. Now, being the fact that the death cross is playing out and gaining more momentum to the downside, and being the fact that you got rejected off this downsloping trend line, I do favor this sector to see more downside in the near term. My next big level would be likely this gap fill around 131, and then even testing the double bottom range over here. But I do think you have a great shot at breaking that particular level. And obviously those names, the important names to watch in this sector, like Amazon, you have Tesla, you have Home Depot, you have Nike, which is an interesting chart playing out, McDonald's, Starbucks, Lowe's, Target. So definitely pay attention to a lot of these key names. So far, the XLY consumer discretionary is actually bolstering a 9.62% year-to-date gain. So it has been one of the better performing sectors year-to-date, and we could see more money flow starting to flow out. All right, let's touch base on communications. Communications have been the #1 performing sector of the year. So far year-to-date, it is up over 18%, 18.05% to be precise. Now, in terms of this sector, considering it is at a whopping 18% gain basically year-to-date, I'm favoring that there's going to be some rotation of capital out of the sector. One of the things I'm seeing right now is you're at some clear resistance, and notice how you peaked above it on here and you had almost that failed breakout. The one thing I've observed on a technical basis from these failed breakouts is that when you have a failed breakout at a critical resistance level, the market makers like to retest that zone to see if, okay, maybe the bulls have one last final push to see a potential move to the upside. Now, what could potentially be occurring here, there's also, if we are bullish on the sector, which I can't be bullish right now, we have to be mindful that there is a potential inverse head and shoulders pattern. Now, the only thing I'm worried about right now is that the markets are extended and this sector is extended as well. So I am watching this pattern, but it hasn't broken this key neckline over here. You really need to get a weekly close above this neckline to entertain this move. And I mean, if this were to get a weekly close above this yellow trend line over here, this pattern would likely push you all the way back up to probably about 76, 75 bucks. So that would be a whopping move to go long in some of these names. But again, that is not my base case. The pattern has not played out yet, and we just have to be mindful that we are stuck at resistance in the near term. And again, look at the key moving averages. You have the 100 weekly, you're below the 200 weekly, you're above the shorter term weekly ones, but at this point in time, you have to respect the resistance until proven otherwise. Some of the key names to really pay attention to: Meta, extension move. It's been crazy. Verizon, T-Mobile, Google, Comcast, LYV, Chatter. So there's a lot. Netflix is potentially forming a little bit of a topping formation with the left shoulder ahead, a right shoulder forming, broken out of this upsloping wedge pattern. So let's just be mindful that there's a lot of potential weakness that could be occurring in some of these charts, which would obviously weigh in on the communication sector. Let's take a look at the financials because they are still the talk of the town, the most interesting, and there's certainly a lot transpiring with potential more bank failures and all of the craziness that is occurring in our financial system. So XLF, you can clearly see, look what it's hitting, the weekly 200 in a pretty oversold 3-bar surge to a low. Now the last time you hit this weekly, you got a big bounce. So I'm thinking that there is a shot that we can get a bounce in the financials. So the last time we hit this bounce, you got a pretty ferocious bounce all the way back up to about 36, even up here 37. Now my perspective is that since there's so much weakness in the financial sector, I think the bounce at the minimum will take you maybe about a 382 retrace, maybe a 50% retrace at the most. But I just think there's too much risk. I think there's too much risk being priced in by the bond market in terms of credit default swaps. There's too much contagion and exposure in the financials for people to really be sticking along. Now you could be playing this as an investor. You could be bottom picking this area and just having a weekly stop loss close below this level. But the thing about this sector going long in a time of a banking crisis is really, it makes it difficult to know whether or not another bank is going to fall off a cliff. And even if you have a diligent stop loss, you could wake up to the financials gapping over that stop loss. So you just have to be mindful. If you are bottom picking this key area, even if you have a tight stop loss at the low, who's to say the financials can't gap over that in the near term? Now, obviously from here, this particular price in time, you would have to have about just about a 1.9% gap over a stop loss to basically negate your stop loss. And then if you're not paying attention, you could basically be losing on your trade pretty quickly here. And a 1.9% move in the financials is certainly not out of the question in terms of gapping over a stop loss. So it's a lot of risk in the near term that definitely has to be accounted for, which is why, frankly, I'm just staying a little bit away from these. I mean, if you look at the key names like JP Morgan, I mean, JPM has also broken this key trend line over here with clear conviction. And you did bounce off of the 50 weekly and the 200, so there is some support there. And being the fact that JPM is a leading bank stock, it hasn't come unscathed. I mean, this banking crisis has also hit JPM stock pretty hard, although it is still up off of these significant lows over here. If we continue to see more weakness in the banking sector, JPM is likely going to come down. And I actually have a new price target based off of JPM making these new lows. I have a price target of about 110.60 coming down to fill this gap, maybe a pierce of 110. I think JPM does stand a chance to get a near-term bounce, maybe 1 week or 2 week bounce if the markets hold up. But I do have a downside target over the coming weeks to months that JPM should see about hit of that 110 level, and then we'll have to reassess from that point in time. But there's a tremendous amount of weakness that's continuing in a lot of these stocks. I mean, look at MedLife. You're hitting the weekly 200, but again, that's so crazy to think that this stock has just collapsed. You look at Bank of America hitting some support, but again, busting through all of the key weekly moving averages. This chart is super bearish. Wells Fargo busting through all of the key weekly moving averages. So there's just a ton of significant weakness in many of these financials. I mean, again, busting through all the key moving averages. So definitely keep paying attention to the financials, because they should be a little bit of a market signal whether or not we can continue to rally or we're likely going to see lower lows. So let's take a look at the industrials now. The industrials are holding up a little bit better compared to, some of the sectors. However, one thing I'm not liking about the industrials at this point in time is that you're starting to get a weekly close below the short-term 20-week moving average, and then you also close back below the 100 weekly moving average. So you're kind of sandwiched in between these two key moving averages up here, and you're still above these two major moving averages up here. Now, the only thing that I'm not liking is that you did try to push back up and close above this weekly 100 moving average, and you got rejected. Basically, you got rejected late in the week, and that is not what I'm liking from a technical standpoint. I still think that with this hard reversal, a gap down, and making a new low in this trend should signify that this chart has more weakness. Now, what I'm watching is basically this wedge pattern over here. I think there will be a little bit of near-term support at around this 92, 91 maybe. But I do think that you're going to retest this weekly 200 MA. That could be a buying opportunity if it comes into it in like a pretty steep sell-off period. However, I do think eventually you're even going to pierce that particular level just with the way this overall pattern is basically starting to set up. And considering what I'm viewing here is you were putting in this bullish consolidation, what looked to be bullish, and now you've pretty much broken that trend. So if this chart was forming a bullish pattern to break out and that's now failing, it likely means we're going to go test the low range of this area before we had this magnificent move off of the lows. So let's just pay attention to that. In terms of industrials, they've been year to date, they're down 1.32%. Really, they're not down that much, but they're not up either. So it's just kind of been more of a neutral play from this standpoint in 2023. Some of the key stocks in the industrials, obviously, likes of Caterpillar. You have General Electric, which has been a powerhouse stock. You have United Parcels. So definitely pay attention to some of those names as we move forward in the trends. Let's look at the consumer staples, XLP. So consumer staples on the year have been, the year-to-date performance is down minus 2.2%. 2.12%. Really, it's also been more of that neutral sector. In terms of this particular chart, there are some positives. The positives that you're back above the weekly 100 and you're back above the weekly 50. Now, you do have lots and lots of resistance up ahead because notice how this was your bearish consolidation. You broke down, never confirmed outside of this weekly hammer bottoming tail here, but you still have lots of resistance in this overall bearish consolidation. So what likely took you lower over here should see some more sell side pressure, maybe after you move up a little bit more to about the $73, $74 area. That's where you should see some decent resistance. But ultimately, XLP is chopping at the highs in this wedge pattern. Wedge patterns at the highs are notoriously known for breaking lower. I still have a downside target of around 65.60. Looking at some of the important stocks in the consumer staples, you obviously have Walmart, Pepsi, Procter & Gamble, and then Costco. So just in terms of Walmart, I mean, full disclosure, we are shorting Walmart, and you've been seeing heavy insider sellings from the Walton family, so, and specific key insiders. But what I'm noticing here is here's your high, here's your lower high, here's another lower high that we put in. Now we're just chopping, and I think we're putting in this beautiful, beautiful potential head and shoulders on the weekly. Here you have a left shoulder, a head, and you're maybe forming this right shoulder. Maybe it does suggest that you can push all the way up to this 145, 146, but I do think you're going to roll over. And with the selling that is occurring from all the insiders, I mean, there's no small sell. They're cashing out billions in stock. When insiders are cashing out billions, pay attention very, very closely. In terms of Costco, that's a heavy weighting in this sector. Take a look at Costco. Costco has basically been chopping in this wedge pattern quite a long time. I have a downside of hitting basically 360 at some point in time. That's still a ways away. There would be a lot of tradable bounces before we get down there, but Costco is just chopping in this wedge pattern. And basically, yes, it's looking like it's trying to recapture that wedge, but right now it's at resistance. You're at some very, very key resistance. Here, when you broke out of the wedge, you managed to retrace and recapture it. Is this going to be a similar thing where you basically have broken out of the wedge and you recapture it, push to the high of the wedge, and then get rejected? That's kind of what I'm watching in the near term on Costco, but definitely pay attention to this specific stock because it is a market leader in the overall component of this consumer staples sector. Let's take a look at the utilities, XLU. So utilities, from first glance, basically utilities are looking very bearish. Now, there's a positive. The positive is that you had this beautiful wide range green bar last week, which basically got rejected off of the 100 weekly moving average. And then you actually had a hard sell-off to basically start you at the week below this wide range green bar. However, it managed to reverse to the upside and you closed back above the 50% mark of this green bar. So that's a short-term positive on the weekly basis. However, don't skew those short-term positives with the overall trend. Look at the overall trend. You're getting choppy. You've made your high. You made a lower high. You've made, a lower low. You made a lower high over here with the weekly hammer. And you failed your bullish consolidation breakdown. And look at these key moving averages. Below the 50 week, below the 20 week, below the 100 week. That is not positive. Now, in the short term, could you push up and test the 20 weekly moving average over here, which would likely coincide with this downsloping trend line? That's looking probably likely at this point in time, but it's really going to take a market bid. I still remain over the coming quarters very bearish on the sector. I think we fulfilled our first downside target that we gave a few weeks ago, which is this dotted line. And then the second downside target I have at the minimum is at least retesting this $61 area, and then we'll reassess from that point in time. In terms of utilities, some of the key names that you need to pay attention to are like Consolidated Edison, WEC, Southern Copper. So I mean, a lot of important names in this particular sector because it is going to give us a little bit of a glimpse of how the economy is doing. And then even if we look at NEE, which holds the biggest weighting in the sector, NEE has been, I believe it's been forming a bearish pattern. So yes, NEE is not looking good in my opinion. You've broken all the short-term weekly moving averages. Notice how all of these moving averages are tight in a very tight range. This is because bearish consolidation is happening. Yes, you do have a weekly reversal off that 200, so there is support. You have a tradable low to trade against, but look at this key trend line you're retracing to. And you're struggling. You've been struggling now for 1 week, rejected. 2 week close above. 3 week pierce, but rejected back under. So lots of selling still occurring in this chart. And let me be clear, once these moving averages start to slope down even more, it's likely going to push you, and it looks like I have a downside target on this particular sector, much lower. I think we hit 65, 66, about a 65 maybe dollar level, probably within the next 2 to 3 months. And then I do even have a longer term downside if we start heading into a deeper contraction and where GDP growth starts to soften up significantly. So definitely pay attention to this particular stock because it will tell you a lot about the overall utility sector. All right, let's take a look at XLRE, which is the real estate. There's lots to discuss here. Obviously, we're discussing this wedge pattern, upsloping wedge pattern. It is broken to the downside. Now, XLRE, I remain super bearish on real estate because it is hitting and breaking key levels. One of the things I'm looking at here is you have a series of lower highs, and then you've also tried making basically a lower high here, a little bit of a lower high or a higher low over here, and then you also made a little bit of a higher high over here. So, but the fact is now you've lost that trend and you've broken it. And look at all the key moving averages, well below all of the key moving averages. And this is all on the back of interest rates and yields softening substantially. So why is the fact real estate getting slaughtered in an environment where interest rates are softening to a degree, a very sharp degree? Even if you look at the yield market, which I won't pull up on this chart, the 2-year yield, the long end yields, the short end yields have all collapsed in recent sessions, and real estate has also collapsed. So there's a bigger problem lying under the surface for real estate, and I think it's going to be imperative to pay attention to the sector because often these ETFs typically lead the physical real estate market, and if these physical real estate markets start to decline and hurt the real economy, that's where you're going to start seeing significant declines in asset prices because real estate is such an important piece of the economy for basically every single country in the world. And if there's a global real estate issue, I do think that some countries are better positioned, but if there's a global real estate issue, that's not going to bode well for asset classes as a whole. And when you think about the physical real estate, it is one of the only asset classes that have been holding up. Bonds were slaughtered, stocks have been slaughtered already, and if real estate starts to slip, those liquid assets are also going to be sold off. Even if you look at like IYR, I mean, this is such an interesting chart because let me just erase all of these trend lines here. Look at this bearish price action in all of the moving averages. You're almost approaching a near-term death cross in the 50 and the 200. Typically, before the cross, you get a big sell-off. So obviously, we've seen a big sell-off approaching over here. So it's likely that cross is going to happen. But there's still a lot of room between the 50-week and the 200 to see more downside, which would push these moving averages even closer together to form that death cross on the large-term time frame. And then likely when that death cross does actually happen, that's when you get a bounce in real estate. So we always like to pay attention to the formation of moving averages before those fancy names, the golden cross, the death cross occur, because it's really the move leading up to that, fancy death cross or fancy golden cross that causes the conditions to occur to create that death cross or golden cross to happen. But typically you see a bounce from a level when it's a death cross. You typically see a bounce happen as those two moving averages intersect, and it's the buildup and the decline ahead of time that causes that death cross to occur. Now, I remain bearish because look at this downtrend. It is clear. I have a downside target of about 68. I think you likely will test the 673 area. You can see this multi-week of consolidation over here right along this 200. I think that's going to be your next big support. It also coincides with these major pivots over here. I think that's probably going to be tested maybe in the next 3 to 8 weeks. You know, don't be surprised if we can see a sharp move down there. That's obviously the market. If the market starts to deteriorate fast, IYR will also be hit very quickly. But my overall downside target, I think we still have to come fill this major weekly gap around 64. And let's just say that if this continues to grind lower, you know, this drop over here was a one-off event during COVID, massive stimulus, but this is just a grind lower. So I think the trend is clear in real estate. I think even the physical real estate is going to have this grind lower and lower and lower, because this type of selling is a lot different to this type of selling. And we haven't even seen real panic yet occur in a lot of these real estate sectors. And if that does, it likely means we're going to be heading much, much lower. And just for curiosity, I want to draw in this trend line on the IYR, which signifies that. You can see we pierced it and you were saved. But once you lose that trend line, I mean, that's going to be a pretty hard waterfall sell-off that could occur in the overall real estate sector. So definitely pay attention to that. Let's take a look at the XLB. So XLB, obviously we're watching this wedge pattern. Clearly it was a breakdown, retrace, rejection. Now look, you're below all of the key moving averages again. This is definitely on a sell side signal. Likely you're going to test the 200 weekly. But considering we've bounced off of that level, it won't be boding as big of a bounce as you got here. The trend is not your friend. Again, my downside targets are even for it to pierce to these pivot lows. But we'll just have to reassess at that point in time. But definitely this is setting up for a bigger move to the downside. Could you be putting in bearish consolidation here for maybe in a couple more weeks? That absolutely could be the case, but it likely means you're going to see more downside. Now, in terms of the year-to-date performance, materials are down 1.12%. So a couple of the key names that I like to pay attention to are like Nucor, Lind, LINDE, which we can pull up now just to take a look at, because it does hold the most in terms of a larger weighting in this particular sector. So taking a look at LIND, it has actually been holding up relatively well, and you are on watch for this potential breakout. Now, you really need to continue to hold this bullish consolidation. If you lose this red line over here, that would be a pretty harsh breakdown to the downside, which would cause a steeper decline in this particular sector. Taking a look at FCX, Freeport-McMoRan, that one's also basically breaking some key levels here. So I'm not liking the overall breadth in this sector. Really, there's a handful of names like Lind that holds almost a 20% weighting in the XLB sector that is holding the sector up. But if you look at it as a whole, a lot of these names are showing relative weakness, and the breadth in the sector is really starting to deteriorate. Let's take a look at XLE Energy. So energy is not signaling healthy things. We've broken the key short-term weekly moving averages. It's starting to roll over sharply. We've broken that wedge pattern that we've discussed. And yes, energy did get a bounce, but we're starting to see the leading sector of last year really starting to roll over. And that's the thing about bear markets, is that eventually it comes for all sectors. That's why, you know, if you were an energy bull accumulating up here, that was not wise, because you're chasing a sector that has outperformed everything. And if you know anything about consolidation, capital rotation, potentially economic conditions deteriorating through the raising of rates and entering a new paradigm cycle, energy is not the place you want to be. I do believe in the long-term thesis, but it's clear the technical picture is breaking down, and you're likely going to head lower. I think at the minimum, you come and test this double bottom range over here, but I think you even will head lower than that. I think the next major stopping point is going to coincide with the very low in oil. And I have a price target worked out in oil that is much lower from the current environment that I do think we have to suffice. And until then, until oil bottoms, I think energy could be in for a great deal of trouble and a lot of profit taking. And when energy really starts to sell off, I mean, you have hard waterfall sells. You do have exceptional rallies, but these rallies never really took out the main pivot highs and closed and confirmed above. So I think we're entering a new paradigm here where, notice how during this whole trend over here, you're above the 50 weekly moving average. And now look, you've closed back below, and a clear rejection off of that level has been observed. So lots of weakness across a variety of sectors, but basically technology is going to be the big one to pay attention to because it does hold the highest amount of weight in the overall S&P. So certainly pay attention to technologies and financials because they're going to be able to give us that extra insight into the market. And I think one of the reasons technology has outperformed is simply capital has rotated out of banks. There's some investors, there's a lot of hedge funds, institutions, money managers that always have to be long. And I've definitely observed that the breadth of this market has deteriorated and it's really being held up by a few stocks, a handful of the FANG names, but specifically Apple, Microsoft, and NVDA have been holding up this market. And I think one of the reasons they have pushed higher than most people expected is because of the capital rotating out of the banking sector into these mega cap tech names that have massive amounts of cash that if they get into trouble, they could definitely see a little bit of a more insulated cushion to the downside. But in reality, if you think about where a lot of these mega caps store their money, where do they store their money? They store them at the banks. So imagine a lot of these key institutions go under that they have a lot of these hordes and hordes of cash at, and they're not insured up to the 200, they're only insured up to 250,000 max. Who's most exposed? It's not the average median person in the States that have about 5,500 in their debit account. It's the mega corporations and investors that have millions and billions of dollars sitting in bank accounts. Yes, they're probably insured a little bit more, but in the grand scheme of things, if that FDIC doesn't kick up more than 250,000 in insurance, it opens up a lot of these ultra net individuals, companies, etc. to a whole host of risk. And that's what I'm paying attention to. So don't be surprised if technology sees capital rotation to the downside. And don't think technology is invincible to market declines just because it has been showing some relative strength while the remaining, basically more than half of the market has been showing a great deal of relative weakness. On that note, I'm going to thank you all for tuning in. Please definitely hit the like button, subscribe. Please comment any of your thoughts where you agree or disagree with our analysis. I continue to want to try to challenge and have other sides to a story to see if we're thinking about all of the variety of perspectives. And definitely feel free to leave your opinion on the comments to see whether or not we've touched base on key information that you think is helpful to your analysis and investment thesis. And overall, just continue to watch these trends. I do think that trends make it if you follow trends as an investor, you have a clear advantage over the general market. On that note, I'm going to bid you farewell and thank you all for tuning in.